Today, we'll talk about gaps and how can we trade gaps. We'll cover different aspects of inefficiency trading. First of all, we replace an old indicator with a new one, which is much simpler and more useful. We'll look at E-mini features S&P 500 and Nasdaq. I'll go over trading examples and trading practices for day trading and scalping. We have so much to cover. If you are ready, let's start. Welcome our free trading course, all about price action trading strategies and smart money concepts. With this video, I'll cover the basics of opening gap trading. If you are looking for a structured table of contents, I set it up for you. You can find it on Google Drive or directly from my website, which is in the description. It is important to watch videos in order so you will not miss anything. Okay, as you remember, a couple of weeks ago, we started talking about inefficiencies. Let me quickly cover what were inefficiencies and then we'll look at more examples of how to use them. We've been using classic fair value gaps from the beginning of this channel. I'll skip the explanation because you already know what it is. Some people ask me about volume imbalances. Why is it called volume? Actually, it does not have much to do with transaction volume. It is more like the candlestick's body volume and intersections between two candlesticks. As you can see, we have only wicks, and wicks are considered as gaps. So, lack of body volume, but only wicks. Now the gaps. Actually, gap trading strategies exist from the beginning of markets for tens of years. Prices always try to fill the gaps back since stock markets exist. Today we will focus on gap trading ideas because you can write an entire book about gap trading only. A couple of followers of mine mailed me and said they find this indicator kind of complicated, had some sort of issues. I personally did not have many issues with the indicator except for the balanced price ranges. So last week I sat down and tried to find the most basic Tradingview indicator by going over each indicator one by one for all the followers and the community. I find the neatest and the most useful indicator for all the inefficiency traders. It's called Imbalance Detector Indicator. Do not worry, it is fully free, nothing to pay. It has all we need and is very easy to use. It is like a 3-in-1 indicator. Fair value gaps, also known as imbalances, opening gaps, and the volume imbalances. As you know, Tradingview only allows free users to use 3 indicators. I think this indicator will help you a lot and save slots for other indicators. For the settings, it's actually extremely simple. The one thing I like about this indicator, you can decide how much you can extend the boxes. This is a personal preference. I set all of them to 5. It also has some kind of dashboard feature, but I'm not so interested in it. You can check it and explore it if you want. Let's talk about electronic and regular trading hours. Most full-time traders in the world use electronic trading hours because most serious traders are generally trading futures, and extended hours charts help us to see a full session. But believe it or not, most casual traders and casual investors actually use regular trading hours. Most people in the world do not care about 24-hour cycles or full sessions like with serious traders. What you see here is an electronic trading hours chart. It looks very identical to our eyes. There are no gaps at all, no big spaces. Now let's switch to regular trading hours. Now, these are the regular trading hours that most casual traders and investors check out around the world. OG means opening gap. Almost every single day, you'll notice these big gaps when the market opens. Why? Because the price when markets close is not the same as when the market opens. There are after hours and pre-market sessions which full-time traders, hedge fund managers, and very big investors continue to trade. All those activities are excluded from the chart when you use regular trading hours. Today, I'll be talking about United States E-mini futures EQ and NQ. However, I'll also talk about Bitcoin CME futures in the future. If you want to check for Bitcoin, type BTC1 as the ticker. You can see all the gaps as well. Not all the gaps will be filled. As with any other strategy, none of these are 100% accurate. Okay, there are two ways to use opening gaps. Firstly, our classic reaction method. The price comes into our gap and reacts to it and makes a shift in low time frames, then we enter. Let's check an example. Here are the S&P 500 mini futures with the opening gaps. I want you to notice this gap, marked as OG. But OG is not enough. What else is there? What else do we have? Any other price action structure? It's a strong SR flip area, as you can see. Let's zoom in on the area and confirm any possible structure shift. We have a strong break right here, but the price never pulls back. It also does not leave any imbalance to trade. Very noisy price action here. Later on, it makes another mini break of structure. It also creates this mini SR flip area, plus a nice imbalance that may hold the price. But none of these matter. I do not care about any of these. Where are the targets? And where are the TP points? I need clear targets. Where is the target? Pause the video and tell me. Yes, this is an equal high. Amazing target. As always, no target means no trade. So simple. Plus, you can see this liquidity void above, which has many imbalances in it. A natural price magnet. This would be an optimal good trade. I would risk full 1 hour for this trade. This is a nice high probability trade in my eyes. What is the second way of trading opening gaps? This time we'll do just the opposite of what we did. We'll not wait for the reaction. Instead, we play to fill the gap. Because sooner or later these gaps tend to be filled. Let's see an example now. I want you to notice this swing failure pattern with this insane opening gap. Large gaps like this tend to be filled much faster. What else here? Again, general SR flip area. These flips are critical to our trading. Let's zoom in a bit on this part. Well, finding a target inside these gaps is hard. The general rule of thumb is 50%, so we expect at least 50% of the gap to be filled. It could be filled more or less. There is no certainty for this. You can also check the left of the chart if any kind of structure collides with the middle point of the gap. In this case, a set of imbalances. So the gap plus imbalance gives us a balanced price range as a target. Let's zoom in and see how we can enter this trade. Okay, in my opinion, this is a messy price action to trade. This high creates the deeper low, and it breaks right here. Even if it is not a strong break, it also leaves an imbalance behind, a possible entry point for us. Later on, it breaks much harder with stronger candlesticks, which also leaves an imbalance behind. This could have been an entry. However, if you ask me, I would not risk more than 0.5 R for this trade. Not like the first example. Still tradable, but with less risk. This is why I've been teaching dynamic risk management. Whenever you do not enjoy a setup, just reduce your risk. Simple. Okay folks, with this video we made an introduction to gap trading and what kind of strategies that we can use. I hope you subscribe to the channel and like the video. Thank you, please take care and see you soon.